Some people consider real estate investment trusts as real estate mutual funds. REITs are a collection of properties managed by a company that buys and develops real estate with funds provided by investors. You can invest in trusts constructing condominiums, apartment buildings, business complexes, or other facilities. Dividends are paid by REITs. These are appropriate income-producing assets for people who want to start investing in real estate without buying the property themselves. Certificates of deposit. Most banks and credit unions offer certificates of deposits or CDs, which are simple to open and understand. In the U.S., CDs are risk-free and insured for up to $250,000. They are similar to savings accounts in that they require longer-term commitments ranging from 3 months to 5 years or more. They work by lending money to a bank for a set period, the term length, with longer-term lengths typically resulting in higher interest rates. As with any interest-bearing asset, the longer the term length or commitment, the higher the interest rate and return you can expect in exchange for losing access to your money for a longer period. Throughout the term, you earn interest on the principal at a rate that is typically higher than that of a high-yield savings account. You'll have to pay the penalty if you withdraw money during the term, so it's not a good idea to invest the money you'll need shortly. The penalty varies by institution and can range from as little as 90 days interest to as much as 18 months or more. You'll need to read the small print to figure out how much you'd have to pay if you cancel your CD early. Remember that some CDs may have lower interest rates than inflation, and you may lose money if this occurs. However, depending on your current financial objectives, investing in a risk-free CD could be one of the best investments for young adults with short-term financial goals. Bonds and bond index funds. Stocks and bonds are mentioned as frequently as macaroni and cheese. Bonds are essentially loans made to the government or corporations. When you invest in a bond, you will know exactly how much money you will receive compared to stocks. Longer-term bonds typically have higher interest rates to compensate you for holding their debt for longer. However, depending on your personal investment objectives and goals, you can choose to invest in bonds of various terms. For example, you may prefer shorter-term cash-flowing assets and thus choose shorter-term bonds maturing in the next few years. Bonds have a lower return than stocks, but are also less risky. Interest rates vary depending on the type of bond and the current financial climate. Bonds typically yield between 1 to 8%, depending on whether you want to buy governmental debt, investment-grade corporate debt, or high-yield junk bonds. Bonds may be appropriate for you if you're looking for a more stable income-producing asset. Alternatively, instead of investing in individual bonds, consider bond index funds, which are available as mutual funds or exchange-traded funds. This is a more consistent, high-yielding investment. This diversifies your risk by replacing a single bond with a diversified portfolio that tracks a broader bond index benchmark. Consider what potential homebuyers want to do with their liquid assets while saving for a down payment as a useful application of bond investing. Depending on the timeline for having enough money for a down payment, investors may want to invest in a mix of bonds and stocks to limit their downside, earn some income, and have some upside as they save more and get closer to the purchase date. Cryptocurrency. Cryptocurrencies are a relatively new type of investment. They are unregulated digital currencies that can be purchased and sold on cryptocurrency exchanges. Cryptocurrencies such as Bitcoin and Dogecoin have sparked much interest in investment vehicles in recent years due to their rapid and dramatic growth. They remain, however, an extremely risky investment due to the numerous unknown factors involved. There is the possibility of government regulation, as well as the possibility that cryptocurrency will never be widely accepted as a payment method. Cryptocurrency currently has no intrinsic value and could vanish as quickly as it appeared. Dividend stocks and stock funds. Dividend-paying stocks are an excellent way to earn consistent income throughout the year. In addition, these stocks are typically from more mature and established companies that can part with their cash flow more easily. This occurs because there are fewer opportunities to invest and grow the company, and returning cash to shareholders is the best way to use these funds. Because no two companies are alike, the percentage rate at which your dividends are paid, dividend yield, varies by company. Blue-chip stocks are quality companies with consistent earnings and regularly pay shareholders dividends. Therefore, all else being equal, they carry less risk than growth companies. These are frequently the companies that many investors target when learning how to invest money with the best stock trading apps for beginners. Investors prefer blue chips because their underlying assets generate income for shareholders, have greater market certainty, and do not require significant risk to continue as a going concern. There are exceptions to this rule, but in general, their size and maturity result in less risk-taking on the part of investors. High-yield savings account. High-yield savings accounts are federally insured accounts that aim to earn much higher interest rates than the national average. As a result, they haven't paid out much to account holders in recent years. However, this is beginning to change. High-yield accounts can earn up to 3% APY or more depending on where you look and the current market interest rates overseen by the Federal Reserve. If you keep your money in an account with a higher interest rate, your balance will grow faster without extra effort. Real estate crowdfunding. It may come as no surprise that many people are drawn to various types of real estate investments for various reasons, including the tangible nature of the investment, low correlation with the stock market, and multiple return components tax advantages. Many people are put off by the hands-on nature of owning, renovating, and maintaining your property and acting as a landlord. Crowdsourced lending or purchasing is currently one of the most popular and easiest ways to get started in real estate investing. Several online platforms meet this investor demand by offering varying service levels, investment options, and investment points along the real estate value chain. As a result, you avoid any aspects you may not want to participate in, such as property ownership or management, while still gaining exposure to these alternative investment options. You have several options depending on the type of investment you want to make in real estate crowdfunding ventures. Index funds. Index funds, like mutual funds, are a type of stock investment that diversifies your investment across multiple stocks. The distinction between index funds and mutual funds is that the index funds are passively managed rather than actively managed by a money manager. Because index funds are managed passively, fewer fees are involved, which means you could earn slightly higher returns than a mutual fund. However, your returns will be entirely determined by how well the index your fund is tracking performs. Given that most major indexes are used to track overall market movement, they perform about as well as the overall market in the long run. In other words, they typically produce an annual return of around 7%. While this is lower than the returns you can achieve by successfully picking individual companies with the right research, it is a respectable return that is significantly higher than savings account interest rates or bond return rates. When you invest in an index, you are betting on America's future. So if you believe the American economy will continue to grow, you should be fine. If you invest in an index and we enter a recession, the market could be down for an extended period. That means your portfolio will also be down, and if you're too close to retirement to wait for things to turn around, you could be in trouble. Another advantage of investing in individual companies is, even in times of economic downturn, the great ones tend to outperform. ETFs. ETFs, or exchange-traded funds, are similar to index funds in that they track and mirror the performance of a popular index. However, unlike index funds, ETFs are traded on the stock exchange. Because ETFs are traded on the stock exchange, you have more control over the price you buy them and will pay fewer fees. But of course, your reward is entirely dependent on how well or poorly the index in which you invest performs. So investing in an ETF that tracks a broad index, such as the S&P 500, can help you reduce your risk. Simply investing in an exchange-traded fund, such as the S&P 500, a collection of the 500 largest companies in the market, allows you to profit from market growth without paying fund manager fees. What do you think of these investment assets where you can invest and become rich? Comment your thoughts below.